The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Felix Moreno, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast. I'm Felix Moreno and I'm here today with David Morgan of The Morgan Report and also silverinvestor.com. Hello, David.
Hello, Felix.
It's great to have you here, David. We haven't had you for a while, and it's always a great pleasure to have you on Gold Money. You're one of the silver market legends. You were recommending silver when it was under $5, if I remember correctly.
Yes, in fact, I was recommending silver when it was at the lowest inflation-adjusted level in human history. And it was a very lonely place to be, by the way. It's proved to me beyond any doubt that people don't buy bottoms. And that's also got an aside, and I'll add on to that. So we're sitting here with the website devoted to, silver research, that type of thing. And basically no one has any interest in it except a very few. And the few that were buying at the bottom were Bill Gates. Bill Fleckenstein was one of his money managers, and he had bought Pan American Silver, which is indirectly a pretty substantial silver investment. You had Warren Buffett, who was buying at the same levels. That was, again, the inflation-adjusted low of all time. And then George Soros was involved with Apex Silver Mines, which is actually a zinc mine that was, of course, promoted to be a silver mine. So the billionaires, not the millionaires, the billionaires, the big smart money was into silver, but the little guy, the average investor, the sophisticated investor, was not involved in the silver market, and yet it was a low, it was a bottom. But again, people don't normally buy bottoms.
So talking a bit about the current price action in the gold and silver market, we obviously saw the highs in 2011, and we've seen a substantial correction, over 30% for gold and over 50% for silver since. Do you think the correction is almost over? And do you think we're going to see much higher prices soon?
I think the correction is almost over. I do think there'll be some more weakness probably through the summer months, but the seasonalities have not worked that well for the precious metals the last few years. Nonetheless, I do think we might get one more low into the gold and silver markets, not significantly lower than the hours we're doing this interview, which is the middle of June 2013. As far as higher prices soon, I do not. I think we're going to get over the breakdown level, which was $26 for silver and $15.50 for gold, roughly. I think we'll be above those levels by the end of this year, but that's about all I'm expecting right now. One thing about making these calls, and I, get chastised for doing them, is that, well, you weren't right. And, no one in this business gets it right 100% of the time. No one. However, when I do my updates and show where I think the price action is going, it's always based on the newest data. In other words, if I make a call and I'm inaccurate, then I will correct it because there's more data available. I did call the breakdown below the 26 level and the 1550 level about a week before it took place. Unfortunately, I wish I could have, had a crystal ball and said, hey, it's going to happen, on this date at this time, overseas market, at this hour. But I'm not that good. So, you just have to take into account what's going on real time, more or less. And it's probability. No one that does technical analysis, again, has a crystal ball. You have to base it on probabilities. And there's lots of clues that the market gives you. So, I'm not ashamed of my record. I'm not even sure I want it to be perfect. I mean, I don't think it'd be human if it were. But I think the main thing to keep in mind is the fundamentals are important, and they are not changing to the worse. They're actually changing for the better.
Exactly. So talking about the fundamentals, do you see gold as just another commodity? Do you think it should be analyzed the same way as iron or steel or corn?
Well, my history of my personal journey has been about money. I was fascinated by money as a young kid, really. And, of course, the silver came out of circulation from 90% to what we call the Johnson slugs in 1965. I was about 11 years old. So that was a tip-off to me that something wasn't quite right in the monetary system. And being fascinated by money, I started to study it at a very early age. So what I determined was that, generally speaking, that when you have gold standard, you have a stability. When you are off a gold standard, you have instability. And it goes back and forth between a stable monetary system and an unstable monetary system. And those usually are based with gold, and particularly with gold and silver. So to me, gold is money, and fiat is quote unquote currency, or really not money, but used as money, obviously. I mean, I'd be an idiot to say it isn't. But nonetheless, we have had episode after episode after episode where money is whatever is based at law, quote unquote, at law. So if the government says this is money and it's pine needles, everyone has to accept that it's pine needles. Otherwise, then they're forced into that. Whereas the money that people have always determined over periods of time, and it could be salt, it could be a sheep, we've heard all that. But really, in more modern times, it's always been precious metals. And so for me, no, it's not just a commodity. It is money. It's been recognized as money, and I think that's a pretty clear case. I mean, certainly you're going to get arguments on both sides, and I don't think they'll ever end. But I think the record stands clear that if money is a store of value, and that's one of the attributes that money must have to be money, that the only ones that stand that test of time would be the precious metals. There isn't a fiat currency out there that's lasted, 500 years or 200 years. So we're in we're in the end game as far as I'm concerned.
So what would you say to Ben Bernanke or Nouri Rubini or Paul Krugman, who accuse those who think of gold as money of being mystics or true believers?
Well, I think they should use the word true and use the word and take it as it's as truth. What's the truth? I mean, the truth is that there are two basic ideas about money. There's specie money, which is money that you can hold in your hand. It's usually gold or silver, precious metals. And then there is some type of an edict money or a fiat money, a money that is conjured, again, at law, and you're forced to deal with it. I mean, barter works just fine. If you want to trade a sheep for a few blankets, then that's fine. But it's very slow. The way that you have a very advanced society is by the division of labor. And the division of labor means everyone gets to specialize in what they want to do the most or do the best. And because of that, everyone prospers. And so then there has to be a medium of exchange that's agreed upon by everybody without force. If you do that in a free market, it's been determined to be precious metal. So these are statists. Statists are people that believe that they have power, intellect, superiority over others. In other words, it's not a free market approach whatsoever. It's the opposite. It's that I'm the state, I'm bigger, better, badder, and smarter than you are, and I'm going to force you to use pine needles in transactions because I say so. That's the attitude. My attitude is the opposite end of the spectrum. My attitude is that you ought to let people be free and determine for themselves how they want to exchange.
Nevertheless, they don't seem to follow through and act on the stated beliefs. I mean, we don't see the central banks holding pine needles or holding corn or holding even oil as a store of value, and yet they still have substantial gold reserves.
Well said, yes. It's an interesting thing. They really are being hypocrites in a way. In fact, if you go back in time, and not that far, and you look at the BIS, the Bank of International Settlements, at one time, the only thing they accounted in, only thing was gold. They didn't care how much fiat, how many T-bills, how many anythings you had. They counted one thing and one thing only, and that was gold. And that's the banker's bank. So, yeah, let's get real here, boys. If it's such a barbarous relic, then why did the banker's bank account only in one commodity? Oh, commodity, yeah, no, not money. No, it's just a tradition. We did that for tradition.
So let's talk about a bit about Treasury bills and the bond bubble. It seems like the budget deficit doesn't get solved. The debt ceiling keeps on getting extended. All the central banks keep on printing more money. How long can this really go on for?
Well, it can't go on forever. We know that. History's very clear. And we're seeing a breakdown. I think, if you look back at the 1929 Depression, and there's a lot of good work by Charles Savoy on my website that's kind of outside the box thinking. But I think if you really were awake and aware, certainly there were guys that made fortunes during the stock market crash. They could see it coming. that it is breaking down. I mean, you have all kinds of facts showing that there's large nation states that are removing themselves from the dollar, China being one of the primary ones, Russia also. You've even got Australia. So these large nation states know, they know what's coming. And so they're trying to shield themselves from a dollar burst ahead of time. And they've succeeded, not probably entirely. I don't think there's any nation state that can entirely shield themselves from what's coming. So it's breaking down as we speak. Yet most people don't understand money. They don't understand history. And they certainly are unaware. And I think there's too much trust in the system. I mean, the whole system is based on trust. And I think there's really too much trust there among the general populace, not so much about the banking system. The banking system, in my view, and from what I've studied, basically was froze up or darn near froze up during the 2008 financial crisis. And this paper that these banks held of each other on each other's books, none of them were trusting each other. That's a generalization, is probably inaccurate at a small level, but nonetheless, that's a general idea. And so the Fed had to step in and say, well, this paper and that paper, we see you don't like it, so we'll exchange it. We'll exchange those CDOs, those mortgage-backed securities, this worthless crap that nobody wants, it doesn't trust anymore, and we'll exchange it for, these wonderful Treasury bonds and Treasury Bills and T-notes. And that's good paper. So we'll take your bad paper, we'll give you good paper. But remember, in the end, paper is paper. So now we're getting beyond the 2008. And so how much paper do you trust? I don't care whose name on it or whose picture or how fancy it's printed. What is it? And so China sees that, Russia sees that, India sees that, Brazil sees that. India, I said already, Australia. So these other countries see what's happening. They know what's going on. And so they, again, are trying to remove themselves from the inevitable. And the inevitable is these things don't end well. And you could go through 1,000 scenarios of what I think could happen, but none of them will come out exactly the way it's going to happen. But will repeat myself. These things do not end well.
So you mentioned China. How much gold do you think China really has?
Probably about 3 or 4 times what their official statement is.
And when do you think they'll suddenly announce that they have 3,000 or 4,000 tons instead of 900?
Well, I'm far from an eloquent student of the Chinese mindset. I've only been there a few times, maybe 4, 5. And it's my opinion that they have a very, very long-range view of things. They do not look out, the next month, quarterly statement like many stockbrokers do, or the brokerage industry here. They look out a few generations. So I'm not certain they would suddenly announce it, but they could. I don't think that's normally how they would do things. And again, this is just opinion. I mean, your opinion on this is as valid as mine. I think that they would just continue to buy real assets slowly over time, not try to rock the boat. They don't really want to cause any trouble, in my opinion. They just basically know what real wealth is. They're taking the trade imbalances that they have, mostly in U.S. dollars, and they're investing them in real things. And they're going to continue to do that in a very, I think, judicial, in a manner in which they benefit, and in a slow, deliberate manner, not, again, to rile any of the markets. However, this market situation could get out of hand without anybody really realizing it before it's too late.
You also mentioned 2008 and specifically counterparty risk, which many people seem to wake up to then, also in 2011 with MS Global and more recently with the Cyprus crisis. Can you explain the difference between paper gold or gold-backed instruments and physical gold?
Well, anything that you don't really hold in your hand is a derivative of some type. And so you really, if you do have your gold stored, certainly there's a lot of hedge fund managers or I guess extremely wealthy, sophisticated investor types or banks that have title to gold. You just want to make sure you have absolutely clear title, or you do hold it, or you hold it in a storage facility that it's there. There's lots of derivatives in the gold market, and that's why for every buyer there's a seller, and that's true. But the problem is, if you're a buyer, do you know what you're buying? Unless you, again, holding the physicality, do you really know what you own? And that's the problem with the commodities markets in general. It's the problem with the system in general. I mean, there's way, way, way too much leverage. There's leverage on top of leverage on top of leverage. So, when you get down to the real deal, what's real and what is not real, the derivatives market is really the problem. I used to go around on my lecture circuit, and I showed a short film about the derivatives problem and what it entailed and how massive it was. And this was before the 2008 financial crisis.
So do you subscribe the view that there's approximately 100 times more paper gold and title to gold ounces than actual gold ounces?
Well, I do. I don't know exactly how to specify it where or Jeff Christian won't take fault with what I'm about to say, but we invite him out to the Silver Summit every year, and he always has kind of more of an establishment view, and Jeff certainly knows the metals markets quite well. They do good research at CPM, in my view. But there is certainly a large factor over the reality, and this is something that, there's really no way out of it in a way. The problem is, of course, that a piece of paper that says gold on it does not equal gold, and the same thing with silver. And because of that fact, there will be at some point in time a discrepancy that will come to the fore. And we are seeing that on the gold side more and more and more. We saw it with Germany saying, hey, I want our gold out of the Fed.
How long is that going to take?
7 years. I mean, I made a big deal of it at one of the investment conferences in January. I mean, this is preposterous. I mean, if the gold's there, you get it back in a few weeks' time or a couple months at the most. I mean, come on, put it on you could fly it over, you could ship it over. I mean, there's lots of ways to get it back to Germany.
Venezuela did it.
For 7 years. I'm sorry?
I think Venezuela got the 300 tons back in under 6 months.
Right. Sure. So something gives. Something isn't right. And then you've got this bank in this Dutch bank that had physical gold for their clients, and they're making them settle in cash. Then there's a lot of anecdotal evidence on the internet about Swiss banks and other banks that are making settlement in cash instead of in physical reality. So that is what's going on. So again, I think if you listen and look carefully, even if you rule out some of the anecdotal evidence that's unverifiable, you look at what is verifiable, Germany being particularly at the forefront, you've got to question what is the true state of the gold market.
It's very hard to gauge, isn't it?
Yes.
In fact, that's one of the things that that seems to be hardest to actually realize: how much gold there is, how much paper gold there is, and how much are investors actually invested in gold, because we still see very small participation among funds.
That's true, and I'll make a comment there that this last smash that we've had with gold breaking the 1550 support level, I have noted directly a few fund managers that have decided that they've had enough, and they did sell their ETF positions, but some of them, while selling their ETF positions, bought physical. So this was something of note. They basically are tired of this derivatives game, you might call it, and decided that, rather than have the luxury of just using a mouse click to be in and out of the gold market, that things are getting to the point where who can you trust, what do you trust, et cetera. And what you can trust is what you can hold. So was that in all cases? No. And I certainly don't know all the fund managers out there by a long shot, and certainly not some of the top ones, but some of the ones through Europe and a few in Asia. And that was their attitude. Like, okay, enough's enough. So I'll sell the paper. I'll take the real stuff. Thank you very much.
But still, many of the ones that publish the quarterly reports and so on, you can see the portfolio allocation. I don't think there's more than an average of 1% invested in precious metals among the top 100 hedge funds. It's probably lower than that.
Absolutely. No, I'll comment on that. I mean, you're right. And I think that's really important to know, because if you had 2% or double, it would double the amount of participation in the gold market. And because of that, look at where this market could go. In other words, when or if, and I'll say when, another 2008 erupts, or there's some type of scandal in the gold market, or any of many, many black swans that are flying around out there happens, then there might be a rush into the gold market, the silver market, and all of a sudden this 1% participation becomes 2% participation. Well, if you double the buying of any market, you're going to send the prices just hugely higher. And that's what would take place. So it's really an advantage in a way to be in early or be in your position that you need or want ahead of the crowd. And of course, this is opportunity, yet there aren't many people that see it as an opportunity now, because basically you have all the gold bugs and all the silver bugs are in the market. Many of them in the last couple of years are paper losses. Some have taken real losses, and they're discouraged, and some are giving up. And until that clears, which I think, again, we're close to that happening, you need new buyers. And to get new buyers, you need rising prices. So it's a catch-22. You have people that are probably willing to participate, but they will not buy bottoms. Remember my opening statement here. And so we've got to just kind of wade through and wait patiently until there's an impetus of enough buying of either people that are already in the market that are adding their positions, or a big buyer comes along, or something of a nation state status, like a China announces more that they purchase more gold, or something along those lines. And then you start to see a price rise, and then you start to catch some momentum, and then we're off again.
Do you think there's anything that could really wake up the mainstream investor to the fact that 10% gold in their portfolios just makes sense, even if it's only as insurance?
Absolutely. Once the ship is sunk, everyone knows how it might have been saved. In other words, after the crisis has occurred, there won't be hardly anyone on the planet that had some wealth worth preserving that wouldn't have realized that they should have had 10% exposure to the precious metals. They'll know it. They'll know it after the fact, but before the fact, no. Now, human nature is fairly predictable, not totally. That's why long-term capital management failed, because it was all based on very sophisticated math that thought they could predict human behavior. It cannot be. But I could say with some authority that after the crisis has manifested and it's too late, there'll be many, many, many that will realize that they wish they had a 10% asset allocation to the precious metals.
Well, I couldn't find a better pick a better spot to end this interview. We've had David Morgan on, a great silver investor and author of the Morgan Report and silver-investor.com. So, David, is there anything else you would like to add?
Yes, Felix, thank you for that opportunity. A few things. One, I would like to add that if you want us to get our free information, we have a YouTube channel called Silver Guru. We also have a Twitter feed called @SilverGuru22. We also have a free e-letter that comes out weekly. That's on the website. Just go to themorganreport.com in the drop-down menu and sign up for our free email alert. And lastly, we have a sister site that we put analysts on, some that work with us, some that are outside of that domain, but certainly good analysts. It's called Riches in Resources. That's richesinresources.com, all one word. These are individual analytical reports on various resource companies, and we're building that site, and it's something I want to make your listeners aware of. So thank you for that.
Thank you very much for being here, David.
Felix, my pleasure. Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.